beginning of the session just to allow people some time to gain entrance into our Zoom call. Now, let's get on to the opening and welcome. I hope everybody can see me and hope everybody's got no issues looking at the agenda. Good morning to our members and very warm welcome to our guests. We are so excited to have you here at our finance webinar. Today we're looking at finance solutions that create a sustainable tomorrow. Demystifying it, unpacking it, unlocking it, trying to understand it. And why are we having this? Well, it's because the landscape for financing projects in the area of sustainability is changing. And it's changing for the better. There are many different ways that you can actually fund these projects. There are incentives. There's a regulatory environment, which hopefully is being relaxed. Power cuts, still a burden. And we live in a continent that is blessed with natural resources and so much of potential. So let's get going. Let's equip ourselves with knowledge, understanding that can hopefully fuel our courage to get out there, lead the way, educate others. Whenever you hear a conversation, be the positive person and say, we can do it, we can come out of this. Yes. And today, we're so honored to have such a high caliber of speakers from various areas of the business. And we are grateful for your presence, and we look forward to your contributions. First up, we have Nadia Rauji, a director from Usenzele, who starts to ask the question about how do I use grants and incentives in financing sustainable projects? And can I raise for renewables or even energy efficiency, and what are these requirements? Next up, we would have Dirosh Maharaj. And Dirosh Maharaj is a senior manager at Standard Bank. And I love his questions. He looks at the next leapfrog events for decentralized energy. It's a big topic. The technology is changing. When should one wait to invest in solar? What's going on? I'm having power cuts and I need solutions. He's from Standard Bank and I so look forward to what they have to share. Lastly, and certainly not least, is Benjamin Cornya. I hope I got his last name correct. He's the director from the African office of the Carbon Trust. And he brings it back to energy efficiency. In conversations with him, he always calls energy efficiency the ugly brother to the solar PV stuff and the renewable energy projects. But we believe that it plays such a vital role as a first step in anyone's sustainable journey. And why is such a marginal uptake of energy efficiency? What financing solutions could drive the market in this area? We would hear from our speakers, and I kindly ask you to hold your questions till the very end, where we would engage and put all of our speakers up on a panel discussion. Take it easy on them. Your questions, I ask to please put it in the chat. Put it to everyone, and we'll be able to deal and tackle all of those questions that you guys might have and spark up some interesting debate. That would be about 30 minutes, 25 minutes, and then we'd go into a period of basically wrapping it up for 5 minutes and closure, and you guys can then get back to your various meetings and business. And that's it. But before I leave and start handing it over to Nadia, a little bit of housekeeping. On this Zoom call, you do have the ability, to unmute yourself. But what happens is, if you made a mistake, that can sometimes interrupt.
Taking drugs? No.
Example, Exhibit A. So we ask you, please, guys, please, we ask you to keep yourselves on mute. If you have any questions, pop it in the chat. I will be your voice and try to spark this conversation and debate. I know that my opening and welcome was supposed to be for 10 minutes, but I don't want to take up any more time with me talking about this stuff. I'd like to dive straight into our first speaker, Nadia. Gabriel, would you please put Nadia's presentation up? Or would Nadia, would she put that up? Okay. So Nadia's going to look at project finance for clean energy and technology in South Africa. These are her questions. How do I use grants and incentives in financing my projects? What finance can I raise for renewable energy or energy efficiency projects? And what are the requirements for those financing? So on that, Nadia, are you ready?
I certainly am. And as soon as I can share my screen, I'll do so. Thank you so much, Keith and SAEC for having us here.
You can share your screen.
Thank you. Great. Can you see the presentation, Gabriel?
Yes, ma'am.
Wonderful. So yes, again, thank you so much for having me here today. And just by way of a bit of a background, my name is Nadia Roji. I'm a co-founder and executive director at Uzenzele Holdings, which was established in 2010 with my sister. And we've been raising capital in the market through various development finance institutions and have a specialization in the DTIC grants and incentives. We've raised an average of 53 million Rand in a project and have also co-authored the NCPC and UNIDO's financial guideline for the development of bankable proposals for clean energy projects, which I'll be referencing quite a lot today. And I do urge that the audience looks it up online. It's a free available report. It's extensive and will really help you in the projects that you're looking to finance, whether you're a user or you're a consultant and want to understand what it is that's available in the market. So going through just some of the fundamentals around the bankability of renewable energy projects in South Africa. And this is not unique to South Africa in terms of the fundamentals, but I'm going to put a bit of a flavor around these 7 fundamentals. The first being the credibility of a client. And really looking at credibility, any financial institution, whether it's developmental and grant-based, or it's equity or debt-based, we'll always look at what is the credibility of the client who's applying for finance to me. And what we're seeing is that specifically due to COVID, there's a lot of businesses that have struggled over the past year, 2 years, and whose balance sheets have suffered. So they're needing to look at ways of creating credibility through structured finance solutions where they may have previously had the equity, the own contribution, the skin in the game available to them. They may not currently. And we're finding that businesses really do need to look at a lot of structured financing to boost their credibility to funders. The other being technology and who the EPCM is. Now, the technology itself in renewable energy and energy efficiency is quite vast. And we're looking at the 2 areas, renewable energy and energy efficiency, as Keith mentioned, energy efficiency is commonly known as the ugly duckling in the room as such. But where we look at the different technologies, renewable energy also has various types of technology. Solar PV and wind are very much well known within sectors within the financial institutions. But 10 years ago, if you came with a solar PV solution that you wanted finance for, financial institutions would look at you and really need to understand the project in a lot more detail than they do today. Today, the technology is understood. But where we look at, for example, biogas, waste to energy projects, pyrolysis plants, those technologies are less understood at financial institutions and require a lot more in-depth studies and test cases. So whether the test cases are in other countries and they've been successful or local, often where you're looking at things like waste to energy, you really are looking at local context, because the kind of waste that you have in South Africa with the kind of environment that's in South Africa would be different to somewhere in Europe or in North America, where the environment and the temperature is quite different. So technology and understanding the technology stack that you're looking at is very important. Do the financial institutions that you're going to understand those technologies? And does your team understand technology well enough to communicate what technology you're using? And that's where the EPCM comes in. The funders really do look and fall back on the engineering, procurement, construction, maintenance teams and look at the credibility of those teams. And I know Darosha is going to speak quite extensively on some of the EPCMs that are available in the market, and the credibility around those firms, those professionals. And really that's where a lot of the funders look and fall back on. What funders are also seeing is that there's a lack of feasibility studies and EIAs. Now, feasibility studies are a combination of technical feasibility, which incorporates point 2 that I spoke about, financial feasibility, environmental feasibility, regulatory feasibility of the project itself. So these various forms of feasibility need to come together into a business plan. Now, in the next few slides, I'll explain to you what types of projects may not need the level of detail in terms of feasibility where it comes to certain types of regulation and financial feasibility, technical feasibility. And those are really the types of projects like your solar PV that's going onto a blue chip manufacturing facility. And it's something that's quite understood and available in the market. Where the feasibilities get more and more complex is as you get into new technologies, as you get into more complex regulatory environments. And where we're seeing at the moment where there's a shift in regulation around the sizing of renewable energy type projects, and certainly the feasibilities of energy efficiency, so critically important. Where we spoke to financial institutions as part of the guideline that we put together, one of the biggest challenges that energy efficiency has is that the project owners, or rather the users of energy, so if you look at a factory, you look at a mine, the biggest challenge that those users have, who your clients might be or you as a user may be, is that there's a concern that by implementing energy efficient technology, being motors, etc., there would be a disruption to the current operations and productivity of that factory. So feasibilities here become very, very critical. And this also comes down to who are the off-takers. Are you the user? Are you a credible blue chip entity? Are you a mid-tier entity? Are you a startup? How credible are you as the user to pay back that facility that's made available? Whether that facility comes in the form of equity, debt, or grant funding, the repayability through financial and non-financial returns is critical. And we'll go through that in a bit when we talk around the industry and RE incentives that are available in the market. Fifth is preparedness. This is not at all unique to renewable energy and energy efficiency projects. Preparedness in bankability, in applying for finance, is a challenge generally. How well prepared are you to create that trust and for financial institutions to understand your project, the credibility of your business, the track record of your business? Are your financials in place? Are your management accounts in place? And is the new project, the renewable energy project, the energy efficiency project, efficiently and effectively articulated to these deal makers within the financial institution, to the point that they're able to take it to their credit committee? Credit committee sits there and just looks at risks. What are the risks of this project? How could it fail? So have you got everything prepared in your pack, in your application, to give that confidence to your deal makers to actually take that project through to credit committee and to eventually provide you with an approval and the finance that you need. Regulation is a massive challenge within this industry specifically. You would have heard quite extensively around the various speeches from SONA to budget speeches, etc. We all know that there's a requirement for regulation to unlock. One of the big challenges that funders are seeing is that the project owners that are coming to them for finance don't quite understand the regulatory environment and are not taking those regulatory risks into account when preparing the application. So they're coming to a funder before regulation is in place, or having gone through the various regulatory compliance requirements in order to make that application truly bankable. And then lastly is the size and stage of project. Now, typically speaking, your energy efficiency projects are relatively small sized in nature. There may be a few tens of thousands of rands, maybe a few hundreds of thousands, at most a few million rand, but not the kind of volume, the kinds of values that the kind of deal makers who need to be involved in understanding renewable energy and energy efficiency type projects would be able to allocate their time to. So project sizing is really a big thing to understand. Is your project be appropriately sized for the kind of technology that you're using? So is it a known technology? And we'll go through this in the next slide as well. If it's a known technology, an asset finance solution could work quite easily, and there's no need to go into too much detail of the actual technology, but knowing that you can go straight to asset finance for a 50,000, 100,000 Rand application is important. As soon as you start going into complex technology, complex regulation, and complexity around the types of projects that you're in, the credibility of the client and off-taker, or the applicants and the off-taker, you're starting to need to utilize various different types of funding, and the skill set of the financial institutions in understanding the technology and the regulatory environment is limited. So it's a new sector for everyone. All the institutions, the whole environment is learning everything as we're going along. And this is really where we now see that you've got two sides of financing. You've got your debt and equity options, which are your shareholders themselves, and it could be through existing or new SPVs. There are also financial institutions, of which we interviewed 27. There's really equity and debt in the market looking for renewable energy projects in particular, not as much on the energy efficiency side because of that ticket size issue, as well as the feasibility challenges that are happening in the market. But really the financial institutions, commercial and developmental, are lending money into the market. And there's also lease models that are available, and being innovative around how you structure your lease models is really important if that's the route you want to go. Talking around industry and RE incentives, the DTIC has a budget annually of 6 billion Rand that it looks to deploy in as cash grants to industry. Industry being manufacturers, and to some extent on the infrastructure side to the mining sector. So where we look at the Black Industrialist and we look at CIP as two that I'd like to really focus on. The Black Industrialist allows you to allocate a certain value of your project, of the expansion of a factory, to renewable energy. And in that, where you're looking at up to 50 million Rand in grant funding, a large portion of that can be used for your tools, machinery, and equipment, which would be energy efficient. There's also a 5 million Rand grant allowance for the factory setup. So if you're thinking of your factory itself, is your electrical engineering up to grade in terms of looking at energy efficiency? And there might be additional costs to that, but that can partly be covered through the grants, through the Black Industrialists. So you're really looking at up to 50 million Rand there. You're also looking at up to 50 million Rand in critical infrastructure program. And the critical infrastructure program is the one incentive that does allow for renewable energy of projects of up to 50 million Rand through grant funding. It also allows for the feasibility studies of strategic infrastructure. So where we're looking at, for example, the requirements of energy to allow for a factory or a mine to operate, this is where the critical infrastructure program really kicks in and says, in order for this mine to expand its production and its extraction capabilities, it requires X megawatts, kilowatts, whatever the case might be, of energy. And for that, up to 50 million Rand could be made available to the mine to support that, that project. Later on, we're also going to be talking around SARS incentives, so I'm not going to go into those too much. Really, we are focused on the cash grant side, but there is 12J, there's 12L, there's accelerated depreciation that you should be taking into account. So there are a lot of support mechanisms, and there's a lot of funding that really is available for both renewable and energy efficiency if you are aware of what it is that you require and the different funding that's available in the market. Looking at the different types of projects and sizing, and then the typical type of finance that's available, really there are three types of projects on the RE side. You're looking at individual SSEGs, which were up to 1 megawatts, but are going up to 10 megawatts now. Where you're looking at commercial PPAs, those are typically your 50 million Rand to $1 billion Rand type projects. And then you've got your utility scales, whether that be at municipal level or at national level, looking at an ESCOM type REIPP transaction. Now, looking at the different types of finance that are available, really on the SSEG, if you have a property that you own and that you operate, you could utilize your property finance for that. You could also use asset finance and then private equity finance that's available. So if you don't have the availability on your own balance sheet to access cash for these transactions and projects, there is a lot of money available. It does come down to preparedness, the off-taker, how credible you are as a user, how credible you are as an off-taker. So the principles that I spoke about in the previous slide become very applicable, and technologies that you're using then determine how easily accessible these different forms of finance are. We've then got the commercial Ppm portfolio space, and they're really looking at project finance, mezz, and equity. And if you haven't heard these terms before, really do suggest that you look at working with a professional in the market that can help you structure these transactions in a way that really makes sense for yourself and the funding institutions, understanding the different requirements that the funding institutions would have, cost of capital, tenure, etc. We will go into them very briefly into the next slide as well. And then you're really looking at utility scale. Looking at utility scale, looking at municipal and national type utility projects. The big challenge there is around regulation. And when you look at the REIPPs, for example, we're seeing a lot of people come to us and say, oh, we really see opportunities in REIPPs, we see opportunities in municipality. But in terms of translating that opportunity that we see in the newspapers into real bankable projects, one of the big challenges is that a lot of project owners they're not in the windows, they're not pre-approved as bidders. And so financial institutions struggle to then allocate the type of resources that would be needed to assess these projects and move them from an application stage all the way to financial close. Again, here you're looking at project finance, mezz, and equity finance. There's really a lot of information in the NCPC document that's been prepared, which is available freely online. Looking at the cost of capital and the financing periods, one of the struggles that a lot of financial institutions have is that users, applicants end up, looking at it and saying, oh, well, this is a green project, so I should be getting finance at 2% flat, and they go in and they put that into their models that they take as an application to a funder. That's not the reality. Currently, what we're looking at is on asset finance, a prime +2, prime +17. So really depends on the credibility and risk of the client and of the applicant, the off-taker, the technology that's available and that you're going to use in your project. Looking at the financing periods, you're looking at 5 to 7 years at most. So if you're looking at an asset finance solution, you're looking at it and saying, oh, again, it's a green It's in the green space. So I, as an applicant, expect financial institutions to give me a 15-year term. That's not going to happen. These are the terms that are typically in the market from interviewing over 20 financial institutions. So depending on the type of finance that you're looking at, there is cost of capital requirements and there's financing period requirements, which are quite standard, and there's a range. Again, looking at it and being able to test the different scenarios is important. If you don't have that capability in-house, if you need that external support, it's ideal that you get it so that when that application goes to a funder, it's taken seriously and that it can move through the channels and in terms of due diligence quite quickly. We do help businesses through that process. So we do look at your eligibility, look at your bankable plan. Do you have the relevant feasibilities, regulatory requirements in place, etc.? Work with you on your applications and facilitate that through the various funders. So really depending on your level of internal skill, your access and experience in renewable energy and energy efficiency, as well as the type of project that you're looking at, you could either do it yourself or you could utilize a firm like ours to help you through that process. And certainly where you're looking at the DTIC type grants and incentives, we do recommend that you work with a credible professional from sector. There are approximately 20 firms that do this type of work, and really having someone there that can make sure that you've ticked all the boxes so that your application can move swiftly through the process. And that's really it from my side. And so thank you very much. And I'll be sharing the presentation with the team at SAEC. And if anyone would like to then get a copy, it will be made available. Thanks so much.
Thank you so much, Nadia, and apologies for pronouncing your last name incorrectly. My bad on that one. But thank you. It was so refreshing, you know, to get that picture coming out there, you know, about financing the different solutions when it comes to meeting your needs for these, you know, sustainable energy projects. Thank you for highlighting those challenges. Thank you for highlighting those struggles that the guys are having. Thank you, Benjamin, for also putting in that link in the chat to guide guys around those incentives for energy efficiency. We'll take, like I said, guys, even if you don't have a question right now and you're still chewing on it and want to say, please, you know, think about it. You're welcome to pop it in the chat now, or you can wait for the Q&A session later and then pop it into the chat. Once again, thank you, Nadia. And now, without much further ado, you know, I think we're running a lot ahead of time. So, Dirosh, you know, you've got the luxury of time as well on your side. You're more than welcome to go for it. Like I said, Dirosh is a senior manager for Power and Sustainable Solutions. Dirosh, on to you, sir.
Thank you, Keith. I hope I'm coming across clearly.
100% loud and clear.
Okay, wonderful. So welcome to everyone, and thank you for, you know, inviting us as Standard Bank to, you know, share our views and present to you on this green economy or the renewable energy and energy efficiency space. So I want to thank Nadia as well, you know, for, you know, doing the heavy lifting around the funding piece. It allows me as a bank for once to talk about more exciting stuff that we're doing. So that was very informative, Nadia, and thank you for that. So the slides that I'm going to take you through are going to cover basically four main agenda points. Firstly, we're going to talk to, you know, the landscape and the narrative that's developing for the energy sector as we see it. What we're also going to share with you are some exciting things that we've heard from the stakeholders that operate in this market, from consumers to regulators, you know, across the board, solution providers and the like. And, you know, what that has spurred for us as a bank has been, you know, an area of innovation. And what we actually, you know, there's an interesting platform that we've recently launched that I'll cover on a high level and talk to the details, the important details a bit more specifically on. And finally, to really give you a view of the world as we see it, and to give you context, which we view energy transactions and the solutions that are provided in the space, and how to actually, get a practical view of assessing whether, it's something that from a cash flow perspective, we're going to deem as viable or not. So without further ado, let me, set the tone in terms of the landscape and what we've seen and what we've seen developing. And as I was going through the attendee list, I saw that there's quite a few familiar names. So, what I'm sharing with you is obviously not news to a lot of you. Many of you are industry experts, but we've seen, we've tried to understand the world of energy efficiency and renewable energy through the lens of the local drivers and the global drivers. And locally, I think we all know, we've seen the movie 100 times. The traditional or the legacy setup that we're trying to move away from has been one where you had a large centralized energy producer that was generally a coal-fired power station, and that fed power through an extensive transmission and distribution network. And if, either through maintenance or management of that operation, there was a shortcoming in any part of that value chain, ultimately the consumer picks up the bill for it, or picks up the tab for it. And we've seen that play out in recent years. We've seen, especially in more recent times, the load shedding and the lack of availability of power. But more importantly, what I think many of us have not realized is how costs of energy as a result of this have hiked up. So this is probably one of the single largest drivers in this environment, and actually supporting the drive towards alternative energy solutions and energy efficiency. So, when we show this particular slide to a lot of our clients, they often go back and do an analysis, because, we become very complacent about, these costs. Who can really operate a business without energy? But when you drill down into the detail and you start to see, especially from this inflection point around 2011, how the increases in grid power have actually eaten into the bottom line of businesses in comparison to inflation, it's actually quite a startling picture. So businesses have started to feel this pressure, and it's further validation for looking into these wonderful alternatives that they can look at to reduce reliance on grid power and to improve their sustainability journey overall. So globally, I think these are not uncommon themes to anyone. Decentralization is the flavor of the day. And as I've indicated, in our context, or globally actually, we have favorable economics in terms of technologies that are presented, from energy efficiency to decentralized energy solutions, be it, particularly solar PV. That's been a focus area for us, because in the small scale embedded generation space, there's quite a bit of interest and quite a bit of traction there, but also the unreliable utilities, as I've indicated. So the decentralization theme is something that's coming through very strongly, and it's not something that's just evident in the energy space. It's a theme that we see across the global economy. Decarbonization, a very big focus area, and I saw a question that came up, and obviously there's a lot of ESG pressure that's coming across globally. South Africa is definitely, is slowly aligning to that, to the principles that the Paris Accord and those initiatives outline. And essentially, it's to reduce reliance on fossil fuels and reduce that carbon footprint that all of us on this call are on the same journey on. So decarbonization, also a very critical theme. And then once again, the third most important theme in these 3 Ds that we often refer to them as is digitization. And especially if any of you have been through 2020. Nobody needs an education in this space. We've seen the power of digitization. I mean, on this forum alone, you can tell how well we're able to leverage market efficiencies, economies of scale through digitization. So from a local and global driver perspective, that's essentially how we've seen, the market unfolding and what's guided our thinking and our approach to the market and solutioning for this environment. So something, excuse me, I've got a bit of a scratchy throat today. Something that we embarked on around the end of 2019, it was December 2019 actually, was to try and understand what is actually happening. What are our clients saying? And our clients in the form of solution providers as well as consumers. What's the regulator's view? What is Eskom's view, and what are the municipalities' views on this industry and the challenges that are faced? And what we did as Standard Bank was we pulled a group of stakeholders, including all of those parties that I've just mentioned, into a room to actually unpack and do a deep dive into the industry challenges and the main pain points. And I don't think this block would surprise anyone on the call. Regulation came up as the main pain point. So the purpose, as we continued with this discussion, we thoughts started to develop in the minds of the bankers that were coordinating this, and we started to see the scope that the bank had to actually intermediate and alleviate a lot of these pressures by introducing something to the market that actually protects the industry reputation and provides a level of standardization and comfort and credibility. And the focus for us, the regulation piece, we've seen the tell signs, and we've seen a willingness and a move in the right direction. And however, that's an area that we have little influence over. We do have, as the largest bank in Africa, very good access to to government. However, we know that if a big bank is a big oil rig to turn, government has a lot more complexities that need to be considered, and that's something that we pretty much we order takers on. When it comes to funding, education, skills, procurement, those were areas that we saw as key areas where we could probably in our principles and our values of becoming more than a bank and truly trying to deliver value to our clients. Those were areas that we, that drew a keen interest from us, from what we understood. Now, what you'll notice here is that the blocks are, in varied sizes, and they represent the weighting. So the input we received from the stakeholders pretty much gave us an indication of what the largest challenges were, and that's what guided our approach in this market going forward. So some of the things that that came out of this research, this initial research or brainstorming event, was also doing a deep dive into understanding, subsequently to that meeting, what the actual market opportunity is. And what we gauged was that there's an exponential growth opportunity. I think we all knew that conceptually, but when we did a deep dive in conjunction with the guys from CSIR and our investment banking analytical team, we actually found that conservatively there's probably a supply gap of 5 to 8 gigawatts that can be filled by decentralized energy solutions. And of that 5 to 8 gigawatts, we then went further to understand the top 5 sectors in power consumption that have a decentralized energy appetite. And we came to a number of about 2 gigawatts, approximately. Now, when I speak about this, it excludes any, it's not a REAP or Eskom offtake. This is really the private, demand in the market. And that equates roughly to, if you're talking about solar PV, a 20 billion rand opportunity. So, that's a substantial number and quite a powerful finding or point that we came to, right? From that investigation or that discussion that we did, or the deep dive into pain points that we did initially, we found that, there were there was merit in conducting subsequent interviews and, creating hypotheses that we took to these stakeholders and tested. And eventually, there were themes that emerged. And what we found was that, especially when it comes to the electricity user, the consumer, the three main challenges that they are faced with is around funding, technical, and the legal and regulatory environment. So on the funding side, you have high levels of complexity. I'm glad to say that as a bank, as a dedicated department to the energy or power and sustainable solutions subsectors, we've actually, in conjunction with our wholesale clients or investment banking arm of the business, we've eventually managed to get quite a good handle on this. And when clients talk to us about energy solutions and they've done all the work, we're actually speaking the same language now. So this was definitely a challenge 3 or 4 years ago. A client comes to us and says to us, I want to put in LED lighting, or I want to, install a solar PV plant, and I want to fund it and own it. It was really difficult for a bank to get, their mind around that, especially when you're looking at extended tenors and, that sort of, and also the way it fitted outside, the traditional type of project a client would bring us, like a production line or a new property, that we could wrap our minds around quite easily. So this, I believe, is still a challenge in the industry. And, from a technical perspective, for those of you that aren't technical, that have, tried to engage with this subsector, what a client generally finds is that, they go into the market, and even if they're dealing with credible operators, they find that, they get very conflicting solutions, and none of those solutions are actually wrong. But in an effort to actually create a niche for themselves, these solution providers, sort of veer away from the guiding principles and the standardization that's available, which is really an aim to get to the lowest levelized cost of energy. So when a client then looks at that, not being an expert, it can be quite baffling. And the differing solutions and differing opinions and advice can be quite baffling to a customer. Furthermore, there's, as all of you may know, there's a lot of questionable providers, that damage the industry reputation. So from a technical perspective, a client starts this journey and they end up walking through this fog and trying to feel their way around, really, really struggling to get to a point where they know this is the correct solution for me. And then the legal and regulatory framework can be quite confusing as well, especially to someone who isn't dealing with these types of matters on a daily basis. When it comes to NERSA, ESCOM, or various municipalities, as well as grid code and the various legal and regulatory frameworks that need to be complied with, this can be also very consuming, and essentially, when a client goes through this process, they often find that, out of frustration, they give up. They find that projects are not economically viable because they have to outsource the gauging or scoping of this, and sometimes it comes at quite a substantial cost. Or they become wary of projects where they've spoken to individuals that have had a bad experience, and ultimately there's a lot of benefit to be delivered, but that benefit is not taken up by clients. So from this investigation and research process that we went through as a bank, we found that the goal for us definitely was to support sustainability, and support sustainability by allowing clients access to getting reliable supply and affordable, predictable costs through energy solutions. And as part of that journey, what emerged from that is a digital platform that we've just launched, known as Power Pulse. And what Power Pulse aims to do aspirationally, we've just launched the first version. It's not open source or open access to the marketers yet. It's by invite only, and we still in very much a beta testing phase where it's by invite only to select clients. But it essentially would like to become a digital platform that facilitates, funds, manages, and optimizes Africa's decentralized energy supply. So essentially becoming a market aggregator, a central point of credibility and comfort for clients, and ultimately a platform that allows the acceleration of this decentralized energy industry. So in the current format that this platform has been launched, it allows a client to come onto the platform, a consumer, input information that they have at their fingertips, and the platform has been enabled to actually do a high-level needs analysis based on very high-level assumptions to portray to the client what their potential at their site is from a solar PV perspective. And it already gives a client in that process an upskilling and a learning moment. So it puts them in the driver's seat and they understand, if I'm considering an energy solution, these are the things that I need to have top of mind. If the client then wishes to proceed with the solution, PowerPulse has gone through a process of vetting credible EPCs. Currently, as a bank, we turn away EPCs or solution providers in this space in hordes because we have very specific criteria that needs to be met. And ultimately, if we get to a point that we're comfortable, we add the solution provider to our panel and we continue with them. At this point in time, we have about 36 or 37 approved EPCs or solution providers in this space. And we've selected the top 8 or the 8 EPCs from that list that we've walked the longest journey with and that have contributed most to our book on this 4 to 5 year journey that we've been on. So if the client then wishes to proceed, we then introduce the client to 3 EPCs and it's selected in a, there's a process that's been set up that allocates EPCs to the client in a very fair manner. And once the EPC then goes out and carries out the detailed needs analysis, provides information back to the platform then inputs that into a standardized format or comparison report, showing the client the key variables that need to be considered, essentially pulling out the sales pitch, giving the client that lowest levelized cost of energy view. And obviously, the full detail is shared with the client. And, there's a lot of value that EPCs, deliver in the space. And, they each have a niche offering, especially the credible ones. And, sometimes, that may be a deciding factor. But what PowerPulse aims to do is to really put the client in the driver's seat, provide them with the knowledge, the awareness, the understanding, and the facilitation of introductions to credible operators so that the overall experience is good. PowerPulse is a platform that stands separately from Standard Bank. It's still, within the Standard Bank umbrella, but if there is, the advantage of that is that if the client needs a funding solution, that funding solution is available to them. So this is the innovation that we've, or the innovative space that we've been playing in terms of providing or creating, or adding to the credibility of the industry and protecting the reputation of the industry and ensuring that our clients, especially, starting with Standard Bank clients, have a good experience if they embark on this journey. So, with that said, it's probably important for us to understand, when we as a bank look at this commercial sustainable energy journey that clients embark on, how we actually conceptualize it, where does energy efficiency fit in, and how does it normally present itself to us as a bank? So when we sit with clients as an energy department and they ask us for advice, this is normally the process that we would advise them to follow, right? So critical to this journey is a detailed needs analysis upfront. So you would notice when I spoke about the PowerPulse process that clients go through, PowerPulse pretty much does that desktop evaluation for the client that an EPC would normally do or a solution provider would normally do, but critical in this journey. And that's good, for conceptually to understand, look, this is the potential at the site that I have. But practically, it is absolutely critical that a detailed needs analysis is done where you're dealing with a credible EPC that understands us, that comes out and provides, does the correct measurement and metering and understands the load profile and the demand profile of that site. So this is a critical first step, and generally what that would point to, as you know, Nadia and Keith alluded to in their comments earlier, is that efficiency is probably your first pit stop on this journey. And it's generally your best, you know, when we've modeled this from a return on investment or, you know, payback scenario, you normally find you get your best bang for buck in this arena. And it's because through energy efficiency, many of you know, but for those of you that don't, you're basically addressing, you know, your peak demand. As you know, you do bring down your consumption as well, but overall, but your peak demand charges is what's probably the major lever here. And energy efficiency speaks to not just LED lighting, it speaks to your heating and cooling, it speaks to energy management, power factor correction, and your load management. And that would normally be the first, you know, pit stop that a solution provider, credible solution provider, would address with the customer. Once that has been addressed, and generally as part of the energy efficiency solution, energy management and optimization is included in that recommendation. But those are essential parts in this roadmap as well. And only once those components are addressed, then we start looking at alternative energy sources. And there's a reason for that. So we look at you know, alternative energy sources at the end, because generally, you know, look, if you're talking about solar PV, practically what we've seen is that you run out of roof space before you get to any, you know, notable size of system. But there are those clients, especially in agriculture, where they have vast spans of land that could accommodate a system that would, you know, replace the full load. And if these steps have not been addressed first, you run the risk of oversizing that system and of actually, you know, creating a lot of wastage and increasing the costs instead of getting a truly sustainable, energy efficient, you know, framework. So when we embark on this journey alongside clients, this is the guidance that we provide them. And as you can see, you know, for those that are technical, once again, I think we're in agreement that this is the critical first step. The way these solutions normally present themselves to us, especially where you're dealing with credible operators, and I'm using that word a lot, and the reason I'm using the word credible operators a lot is because we've observed that, you know, I actually feel like a dripping tap saying this, but you know, I've said this probably 10 times this week. If I were to say that 20% of solution providers are credible operators in the market, I'm probably being far too lenient. It's probably, you know, far fewer than that. So it's a gold rush environment, very low levels of standardization, very low barriers to entry. So you have everyone, you know, trying to rush in and get a piece of this. But our focus, like I said, is in the credible space. And when you embark on that journey, you'll normally find that the solution provider would go through this process and provide a wrap solution in many instances. Often when we go into this area, we find that clients, without consulting us, have already received the advice and installed these systems and are now in, you know, in the latter part of this journey. So, you know, the need for energy efficiency funding is readily available from the bank. Because of the short payback periods, it's quite easy for us to facilitate, you know, via the traditional, you know, lending products that we have. But it's an absolute critical first step in this journey, and we acknowledge it, and we reference that when we relate this to clients as well. So I see there's a lot of technical people here, and I hope this isn't, you know, going to bore you, but for those that aren't, I just thought it's important to include this, you know, to give a good understanding and a full picture in terms of how the banks view this and what's actually critical. So as a bank, when we're assessing this, and especially when we're looking to provide funding into these systems or these areas, we first need to understand, you know, what the cash flows related to that system that the client wants to fund, look like. So, these systems present themselves, especially solar PV, in different formats. So you have what is traditionally referred to as grid tied, and that's essentially where a client installs a solar PV plant to extract or to capitalize on the arbitrage opportunity that this cheaper technology now presents. And generally, like I said, that solar PV plant, if it's, if he's using his roof space, wouldn't provide the full component of power that's required, because you literally just run out of space. So it would be installed with an inverter that has the capability of converting, obviously, that direct current to alternating current, feeding it through to the plant or to the site, and procuring what is required from the grid in addition to that, to ensure that the client has 100% of its energy. This is definitely, from a cash flow perspective, the easiest to justify. But the challenge, though, is that if the grid goes down, as you know, if you don't have specific technology and sign-offs, the solar PV plant and the production from the plant is cut off as well. So the second type of solution that we've seen is a hybrid solution, where you have the solar PV plant with batteries, and that's basically to provide 3 to 4 hours of backup. We generally find that this solution, even if you're looking at 3 to 4 hours of backup a day, throws the feasibility of the system out quite badly. We have been able to justify this where a client is able to say to us, the downtime costs during those 4 hours are, massive. And if we can quantify that, we're able to justify the installation of these additional components. But in that instance as well, it only provides a component of backup. You still need the grid for, times when the system is not able to supply adequately. And then you have a complete off-grid system, and this is normally a nightmare for us to try and get our minds around, but it's where the client completely disconnects from the grid and is completely self-reliant, which necessitates quite a large solar PV installation and quite a large battery bank, because you need to account for all those times that you don't have sunlight and for nighttime use as well. But as a banker, our concern is around this key variable. And the kilowatt hours, whether you're talking about energy efficiency or energy supplementation or alternative energy, that is really what we're interested in, because that represents the arbitrage or the replacement of existing costs that would be considered in the cash flow analysis. So in a solar PV context, we would take this value and we would divide it, by the cost of the system. So it's meant to be the other way around. So we would divide it by the cost of the system, and that would give us what we would refer to in that instance as a solar tariff. And, the same concept applies, slightly differently for energy efficiency, but when we analyze the cash flows, it's in a similar context. That would then be matched against, the average, the blended tariff that the client is on. And for these purposes, I've just used, the average in SA as we understand it. And basically, if you were to take that energy procured from the grid at that cost, the client is replacing that cost with the cost of the system. And for us, it's feasible upfront. So ultimately, what this means is that, in understanding this, we started to realize that because energy sits very high on a client's cash flow waterfall, and because they're actually replacing that OPEX line lever with a lower cost, we saw the merit in supporting clients in this. And we provide solutions into the space in two contexts. So the first is the Capex funding for own use. So it's a really own to use model. In that context, so something that we're specific about is that we don't look at marginal businesses. So we really look at established, resilient businesses for these solutions, and mainly because of the type of funding solution and the flexibility that we provide. So when you're looking at a Capex solution, we normally execute that through a commercial asset finance or vehicle and asset finance solution, and that has been quite well received in the market, mainly because it alleviates the need for notarial bonds to be registered over those assets, which reduces the cost, and the general pricing in asset finance is better than a medium-term loan. we're able to go up to 10-year funding and 100% loan to value. But bear in mind that is, through the context of resilient, strong businesses, and a detailed assessment of the borrower is obviously required. We are a bank after all, but the standard conditions apply when it comes to asset finance. In addition to that, however, if a property is rented, we would have to ensure that a long-term rooftop rental is secured, and the term of debt would be limited by, the remaining lease that the borrower has, the remaining time that the borrower has on their lease. We'd like to take a session of short-term insurance policies there where possible. Something that's becoming much more prevalent in the market, and I would say probably a large component of our book now centers around these discussions, is around PPA funding, or, it's not always a power purchase agreement. It's sometimes, a rental, a lease to own. So they come in all formats. So a contract-backed sort of lend. And these are generally for energy generators in this space. And you'd find, these sort of opportunities emerge more and more as the bigger corporates start looking at this and looking at, alternative energy. You'd normally find that they've got 20 sites, and that's not their core business. So they're quite happy to just have a stable escalation in a portion of their electricity and for somebody else to manage that for them. And they don't want necessarily the full benefit. They're happy to pass on some of that benefit to someone who's prepared to operate it. And in that emerges the model, for these asset managers. And they normally facilitate this through a special purpose vehicle that contracts with the off-taker. In those instances, we find that for established portfolios that have run at time and, where, you basically prepared to refinance, a term loan is normally the most appropriate type of product, but we can facilitate this through asset finance. We can go up to 10 years where there's merit, and 10 years is really our maximum threshold. So where this is not really required or justified, we wouldn't go that period, but we can, where required, and especially where you're looking at a portfolio type of lend, where you exactly in that scenario where you're pitching against 20 other solution providers, and it becomes a bit of a bun fight, and the margins get fine. The 10-year funding does come to help. We normally need an equity contribution into these structures and a minimum of 30%, where all other variables are quite rosy, but that's pretty much the 70% loan to value is what we look at as a benchmark. Like I said, margins are generally quite fine when you're looking at an asset portfolio, so we can sculpt repayments in this context. However, we need to do a detailed assessment of off-takers. And either, you as a solution provider, if you play in the space, has a investment committee or a credit process, and we have to check how well aligned that is to our process. But if it's not well aligned, we would need look through to the off-taker as if we were lending to them. So we wouldn't necessarily take guarantees from them, but we would need a good understanding from them. In that context, we normally, look at taking a session of the income streams. Look, it's normally a special purpose vehicle. So as a bank, we can get our arms around the assets and the income streams and step in rights quite easily. So that brings me to the end of what I intended to share. So if any of you want to talk to us or intend on engaging with us, this is now the PowerPulse email address. You can take note of it. We'll share that, I'm sure, as well. But yeah, thank you for your time and thank you for your attention.
Hirosh, wow, thank you so much for such a comprehensive presentation. I just want to say congratulations on the launch of the PowerPulse app. Sounds like you just managed to make a minimum value product, an MVP, and the team must be very excited. It's also great to
Thank you, Keith. And yes, the energy is very high this week, and yeah, we've already started engaging with clients. Feedback's been phenomenal. So yeah, that's a fact. And you're welcome. It's once again, thanks for inviting us.
Oh, pleasure, man. We're honored to have you guys over here. Thank you for sharing that case and all of that innovation. I'm sure the guys must have lots of questions. So please, guys, I hope that panel discussion is coming up, and it's going to be great. We're running 5 minutes ahead of schedule, which is great. So it gives us more time. No issues there. Now, to bring it back, Benjamin from the World Bank. Benjamin, are you ready?
Hi, Keith. Yes, ready.
Yeah. All right. Floor is yours, Benjamin. Go for it.
Thanks, Keith, and thank you to colleagues who presented previously. As Keith said, I'm going to kind of quickly finish off this morning's presentations before we enter into a panel discussion. Colleagues may be alternatively disappointed or relieved that I don't have any slides to share. I'm just going to talk to you a little bit about what it is that we at the Carbon Trust have been up to. So as Keith briefly said, my name is Benjamin Cornya. I'm the director of the Carbon Trust office here in South Africa. So that's Carbon Trust Africa. I have been with them for the better part of 10 years, alternatively working in various questions of sustainability and not least energy efficiency for a large part of that. I came to South Africa in 2014 when I was asked to help run the energy efficiency program, the PSEE, which many of you may remember and may recognize. So I was seconded to the National Business Initiative, the NBI, to help deliver that subsidized audit program that delivered in excess of 1,000 energy efficiency audits, predominantly for SMEs and large corporates here in South Africa. I'm been invited here today to talk to you because we're also at the moment working with SANEDI and the DMRE with some World Bank funding to try to understand what kind of finance interventions can be deployed into the market in an effort to try and drive uptake of energy efficiency. So what kind of financial solutions can we bring to bear in an effort to kind of accelerate the uptake? And I've been involved in the design of kind of various finance initiatives, both for energy efficiency and early stage kind of low carbon technologies for in various forms over my career. So let me kind of, launch into energy efficiency. Why is it that we're not seeing kind of substantial take up in South Africa of energy efficiency? Let's kind of cover the basics. Energy efficiency opportunity is substantial. I think we all know that. As part of the project, we've kind of gone and revisited the numbers a little bit that were kind of highlighted by the PSEE and by other programs such as the NCPC's Industrial Energy Efficiency Program. And if we look at those, then we can see that a 15% energy efficiency across South African energy consumption is eminently achievable, which would translate to a massive kind of 430 petajoules. And just to kind of put that into context, that would represent an investment cost of around 320 billion rand, which is $20 billion. So the opportunity in South Africa is substantial. And I think, we kind of all know that, but it's sometimes useful to just put some of these kind of numbers with many zeros around it. What are those opportunities? Well, they're things that we know as well, quite well. It's motors, it's drives, it's compressed air systems, it's lighting, it's heating, it's process heating and cooling. That one came up an awful lot in the audits that were done by the PSE and subsequently by the NCPC. And that's not to count, obviously, kind of the various behavioral changes that we would want to implement, and the role of energy management systems, which today which today are still kind of not really implemented in a South African context. Furthermore, it's commercially attractive. If you look at that portfolio of identified opportunities, typically we're seeing kind of paybacks that are sub kind of 2 to 3 years, even when you start to blend in some of those longer term paybacks, which kind of, are highlighted, which kind of, are seen when you're kind of looking at kind of more complex heating process changes, or even kind of PV, which is today sitting at around kind of maybe 5 to 6 year kind of paybacks. So the point is that, energy efficiency is abounding. It's commercially very attractive. It's and often the kind of the average capex outlays are relatively small. The modal number that we can see in the opportunity that we've identified is sub 500,000 rand. So it's not a lot of money. Of course, there's enormous variability within that, but even at the top end, we're talking kind of a few million rand for kind of small to mid-scale kind of PV systems in embedded generation. So the opportunities are not expensive, they pay back quickly, and they're very available. So why are we not seeing this? Why are we not seeing this opportunity kind of translate into demand? And there's a few things I think which we can kind of explore. I think the blunt answer is today energy is still too cheap. I mean, I'm terribly unpopular when I'm at a braai and I kind of voice that opinion. People look at me and mock horror, but the reality is that energy in South Africa is still extremely cheap if you compare it to most other kind of developing and developed world economies. And of course, it's had a history of being extremely cheap, and therefore kind of energy efficiency really isn't at the forefront of many operations. And therefore we have that lack of awareness, we have that lack of focus, which means that bluntly, opportunities simply aren't being identified. We don't have a pipeline of opportunities being identified. When I speak to ESCOs, when I speak to energy auditors, when I speak to suppliers, very few of these organizations are reporting, the fact that, people phone up and ask for their services, right? That isn't happening. Rather, these guys are having to kind of work extremely hard to try and convince clients of the opportunity and the merits of their services. Often there isn't a technical capacity within organizations, even some of the larger organizations, there isn't the technical capacity to be assessing energy efficiency or to be identifying energy opportunities and then assessing those opportunities in the context of their merits. So how are business cases being developed? How are those being assessed against kind of business as usual capex outlays? Organizations, widget manufacturers, they're very good at kind of instinctively saying that, okay, well, this next capacity plastic extrusion machine or whatever it might be, they're very good at instinctively saying, well, this is how it's going to benefit my business. But they certainly don't have the capability to assess an energy efficiency opportunity in that same context, even though it might be considerably more attractive on a like-for-like basis with a far quicker payback. So, we don't have that kind of, we don't have that history, if you like, of opportunity, of identifying energy efficiency opportunities. So these are all kind of reasons why kind of demand isn't happening. If we look at the kind of the enabling environment, I'd go so far as to say that the policy and regulatory environment is also not particularly persuasive. We have a national energy efficiency strategy, which is still in draft form, and therefore, since 2015, and therefore really isn't kind of translating into any sort of regulatory obligation. Likewise, we have kind of the draft regulation for carbon management plans, which again is sitting in draft and therefore again isn't really kind of driving any sort of behavioral update. If we look at those regulatory instruments that are in play, 12L, 12L is a really it's a good regulatory instrument in and of itself, but the reality is it is really designed only for kind of larger interventions, which of course can support the costs of the M and V requirements around those to prove the energy savings. And carbon tax, we know, is also in its present form and diluted by all of those allowances, which means that kind of essentially kind of the liability is really only kind of up, often kind of around 5 to 10% of the actual kind of carbon tax liability. So today those are not really kind of drivers for the market, and that's a shame, because I'd go so far as to say that the supply side for energy efficiency in South Africa is actually pretty good. There's very good energy, sets of energy auditors out there, thanks to the NCPC's kind of training programs. So availability of energy auditors is pretty good. We've got ready availability of efficiency suppliers, noting, what the colleague said earlier about kind of the potential variability of some of these EPC contractors. So therefore there is, one does have to be careful, but there is availability, if you like, of great suppliers. So, it's a real shame. I'd go so far as to say, and colleagues earlier on have said this as well, that there is availability of finance, but this is where kind of the wheels effectively kind of start to come off a little bit. There has been, I think, a pretty good history of tailored funds for energy efficiency and renewable energy. And this is where kind of it becomes a little bit problematic, because actually, if you look at those funds, either they've struggled to disperse the money, or they've kind of almost exclusively dispersed it on renewable energy. Energy efficiency, if you look at kind of the writing on the wall, it's renewable energy in big kind of capital letters and kind of blinking lights, and then energy efficiency almost as a little bit of a footnote. And that's certainly kind of seen when kind of the, in terms of the disbursement numbers. And that's because more often than not, a lot of these funds have gone through the project finance arms of the banks, and actually kind of, the presentations of the colleagues earlier on, appear to confirm that a little bit. And that's because, these are uncertain. There is a kind of a risk aversion, there is an uncertainty, there is a need, if you like, to kind of, often with these funds to have plenty of evidence to say that, and tracking to say that they've achieved the impact that they've achieved. So often we're seeing those funds go through the project finance arms of the banks. And that means that there is a minimum ticket size involved, because there is the need to really conduct all of the diligence, both at the technology level and at a credit risk level, in order to make sure that that project is viable. And that therefore kind of, if you like, kind of precludes financing of these kind of smaller interventions, which we've highlighted. So, we know that kind of funds like SunRef have really kind of struggled to disperse, despite the ambition to lend into energy efficiency. And as a side note, actually, my conversations with the commercial banks are often such that, banks are not really that interested, or it's not terribly attractive for banks to receive dedicated credit lines from donors. The reporting requirements of those are often quite onerous. And so banks are actually not that incentivized to receive these kind of tailored credit lines. They're much more interested in kind of blending their own treasury functions. Asset and lease financing is a possibility for energy efficiency, and it is something that we've seen attached to particular types of technology. Again, those are probably going to be a little bit more kind of on the more expensive side, not least because obviously asset and lease financing requires to some, rests to some degree on that asset actually having some value at the end of the day. As soon as you start to get to kind of some of the cheaper end, again, this kind of falls over. How many of you would be that thrilled to be offered kind of second-hand variable speed drives or motors, even though they may come with a guarantee or a warranty? The reality is not many of you. So you know, the reality is that energy efficiency, if you think about what we're trying to finance, you know, probably most instinctively, you know, fits into the retail finance offering. So it's just kind of, you know, a traditional debt solution that is probably the most appropriate for the size of ticket, and the fact that often these things don't really have you know, an asset value per se. So, and the banks have plenty of obviously retail finance opportunities, which, you know, they're going to be quite happy to lend to energy efficiency. But this is kind of the interesting point, and that is that you know, retail finance operations within banks are going to be fairly sector agnostic, right? The reality is, if you're leveraging your balance sheet to raise some debt, the bank doesn't necessarily mind if you're kind of using that to buy another widget machine, or if you're using that to change the light bulbs. So, you know, and they're not really going to be kind of that prescriptive about kind of where you need to be spending that money. So, you know, in conclusion, and kind of to recap, you know, where have we landed in the project that we're doing for the World Bank at the moment? Well, we've kind of landed at a place where we have kind of revisited a lot of these kind of barriers that I've just described to you. We've kind of done some work to try and understand why historically energy efficiency funds haven't been particularly successful in the South African context. And we've now at the stage where we're kind of starting to look at kind of what are other potential energy efficiency or other financial instruments that could be used to try and catalyze the energy efficiency market in South Africa. The next stage will be now to start to kind of select, you know, a subset of 2 or 3 of these, and, you know, really start to try and kind of test these in the marketplace. And so what is our hypothesis right now? And I suppose, you know, one might ask the question, you know, how do you get people to preferentially fund energy efficiency? If people are kind of raising debt or taking out debt into their businesses to fund business as usual, how is it that you kind of reorientate them and encourage them to take energy efficiency, potentially, you know, over business as usual investments? And I've got kind of maybe 2 answers to that. The first is make it easy. So by that, you know, maybe there is a need to kind of encourage that that demand or that supply, if you like, of energy efficiency projects. So, you know, does the market need assistance for pipeline identification? How is it that these projects are going to be identified? You know, does the market need accredited suppliers? And does the market need pre-approved technologies? You know, we kind of know really what the bulk of energy efficiency technologies are, right? It's not rocket science. They've been around for some years. So, you know, we should actually probably be, you know, taking a little bit of risk and saying, actually, you know what, you know, these are the approved technologies that we want to see deployed into the market. So make it easy. Identify the projects, approve, you know, get a list of suppliers that people can turn to, get a list of technologies that are going to be easy to fund against. And then the second thing is make it attractive. You know, how is it that we encourage banks to lend preferentially to energy efficiency? How is it that we encourage end users to take out debt or to implement energy efficiency projects preferentially? So what can we do to make that finance product more attractive? How do we make kind of just, you know, vanilla debt products more attractive? Well, obviously we can try and make them a little bit cheaper compared to kind of business as usual debt financing. And we can do that by the use of first loss accounts. So, you know, can we try and underwrite the risk on behalf of the banks? You know, we can do the same with kind of guarantee pools. That's kind of the same thing, really. Or we can do the same again with kind of use of warranties and insurances, you know, by trying to kind of reduce, if you like, both the credit risk and then also the technology risk through those instruments, which ultimately results in not necessarily a concessional product, but a kind of cheaper product than, you know, might be used on business as usual. The challenges with these kind of things is, okay, well, how do you implement it? You know, and the challenges here are kind of around implementability, they are around scale, and they are around sustainability, which are kind of challenges which we'll continue to explore in the forthcoming months. So that's, I think, kind of probably enough from me. I think without further ado, I'll hand back over to Keith. And we're going to go into the panel discussion. So thank you, colleagues.
Thank you, Benjamin. Cornya, I think I got it wrong again. but thanks a lot. It's such a sobering viewpoint, and I love the way you put it in terms of highlighting the potential and you know, looking at the barriers and trying to deal with those barriers. I can't wait to get into the panel discussion. The questions have been coming thick and fast. Once again, from my side, I just want to, you know, on behalf of the SAEC, thank each and every one of our speakers and you, our guests. I look forward to an interactive session, so please don't hold back, guys. Are we in the panel discussion now? I guess we can just go for it. Gabriel? All right. Okay, guys. All right, let's get into the panel discussion. And there was a first question up on the chat, and I just want to pick it up from there. And the question is, I'm just going to try and find who's it from. Excuse me 1 second. Elton Moyo, Elton Moyo, he said, good morning, everybody. How does an investor verify the methodologies of the metrics used for ESG, environmental social governance? What do you see as the future of green bonds / climate finance in South Africa? I guess since Benjamin was up there, Benjamin, you're still fresh. I hope you got the juices flowing. Would you mind taking a shot at this one?
Yeah, sure, with pleasure, with pleasure. And great question. So essentially, kind of, I might paraphrase the question as, what is green, right? You know, that's essentially kind of really what a lot of investors are now kind of struggling to articulate. That, you know, there's an awful lot of pressure on investors, both, you know, commercial banks, but other types of investors as well, to kind of ensure that their investments are increasingly green or have some sort of social and environmental benefit. So, you know, the question is, what is green? And actually, there's quite a lot of work, excuse me, being done around kind of the metrics and the frameworks to try and define what is green. You know, those have been kind of started off by people such as the Climate Bonds Initiative and Carbon Trust. You know, particularly colleagues in London have been quite heavily involved in the kind of definition of the Climate Bonds Initiative rules and kind of what those look like. But it's fair to say that, you know, at that stage, you know, they're still quite high level, and so there are kind of other pieces of work being done to try and develop kind of asset taxonomies. And the most developed one at this stage is the EU green taxonomy. And the really exciting thing is that South Africa is probably, well, no, it's not probably, it is the first middle-income country to pick up that kind of concept and to run with it. And at present, the National Treasury is working on the development of a South African green taxonomy, which will be taken up when it is defined by the JSE, and the JSE will increasingly kind of operationalize, if you like, kind of that green taxonomy. It's pretty easy to define green in asset classes such as energy assets, right? You know, we all know renewables pretty green, and we know coal is not, right? So that's all fine. The challenge then comes with things like, you know, other asset classes. So what is green steel? What is a green road? You know, how do we invest in those? And what are the metrics that we attach to that? And when you're dealing with a middle-income country or a developing country such as South Africa, which is obviously on a journey for transition, something that might be considered not green, let's say in Europe, might be green relative to business as usual here in South Africa. So do we permit that or do we not? And so actually one of the pieces of work that the National Treasury will be kicking off shortly is a transition taxonomy. So there's green, and then there's kind of this interim, what will be permitted, if you like, in the next 20 years, to try and give kind of investors that kind of certainty around, you know, what they can and want to be investing in. And the last point that I do want to make is, what's the future of green bonds, climate finance in South Africa? It's great. South Africa is, you know, has very deep and liquid debt markets and is leading the charge in the development of kind of these alternative products. We as the Carbon Trust offer second party opinions on green bond issuances, and I'm happy to say we've done about 6 or 7 in South Africa in the last 2 or 3 years alone. And okay, that's the bulk of the market, but you know, that's still kind of South Africa very much kind of leading the way in terms of that. So, you know, all of those big 4 commercial banks, they're looking at kind of, you know, social bonds, social and green bonds in some form or another. So it's very exciting. And so I think that's a very positive step forward. Enough from me.
Oh no, please go on. I can't get enough. I want to hear more, really, honestly. And thanks for putting up that link on the chat. You know, colleagues, worth noting the PSC's Guide to Energy Efficiency Financing. Thank you for that link. Much appreciated. And Nadia, thank you for the presentation as well, and the link as well. Zadok, the guy that left me over here to do this panel discussion last minute. Yeah, that's you. He's got a question on case studies of energy efficiency projects funded by banks or private equity in South Africa. I'm gonna leave it open for anybody to raise their hand if they wanna take this one. Well, I'm gonna put you on the spot.
So, you know, if I can maybe, you know, give my views there. So from a bank's perspective, you know, we have funded energy efficiency projects, but I wouldn't say anything substantial that we've actually done a case study around. You know, we've looked at, as I've indicated earlier, our focus area, you know, being a bank, having a captive group of clients, you know, it really has been around the clients that are, you know, keeping us busy, right, at this point in time, the resilient client. So you really have no challenge in terms of extending lines to them. You know, in some instances, the client doesn't even tell you. You know, some of these clients are that strong that they don't even tell you what they're going to utilize the funds for. And we, you know, provide a limit. And later on, when we're going and revisiting the energy discussion 2 years later, say, no, you remember I took that money and this is what I did. And yeah, it's been phenomenal. So from an energy efficiency perspective, you know, that's where what our experience has been, because being a commercial bank, you know, we govern by certain, you know, parameters and guidelines. But obviously, you know, what Benjamin spoke to, there's a much larger opportunity in the market that doesn't maybe get the attention. And it's because, you know, there's that point where there's probably an opportunity to cooperate and really look at portfolios in terms of businesses that fit, smaller businesses that fit within this category, that a bank generally wouldn't have appetite or wouldn't be as easy extending funds to. And that's where, you know, the forms of mitigation and the forms of enhancements that are provided by these, Carbon Trust as an example. We've had some engagements with them. They're doing fantastic work in that area to understand and unpack and figure out how do you unlock value there and actually ensure that value is being delivered. But as far as case studies are concerned, you know, we haven't really gone through that formal research process. In many aspects, if we are doing a lend into for a specific project. Our credit paper is to a large extent, a detailed research kind of, but probably not, in the traditional format. So I hope that gives some context from a bank perspective.
Thank you so much. Thank you so much. I'm going to go to the next question because I like it. It was in the chat. Yes.
I think that both Benjamin and myself have a few items to add there, so that he also picked up his hand.
Go for it, please. Yeah.
So I would echo what Darosh has said. I mean, from the report that we did and the research we did on, the NCPC and UNIDO had actually started off with saying, we want you to focus on energy efficiency. And as we started having the interactions with the financial institutions in South Africa, 27 of them, they really started to say, we don't actually know what portion of the funding is going to energy efficiency projects. So it's certainly not unique to Standard Bank. It's a reality of where the market is at. And I think again, within this subsector, what's really very interesting is to say, you've got renewable energy efficiency. From a technical perspective and engineering perspective, there's a lot of knowledge that's required, and there are a lot of skill gaps. Similarly, within the financial sector, there are a lot of skill gaps. And this whole subsector requires both skills to be aligned in an application in order for it to be successful. It's required in order for the markets. And if you look at the EE and Zadok, we've had multiple conversations as well. If we look at the EE consulting space, the consultants that are coming up with these projects and coming to Benjamin's point around the mid, ticket size on EE, looking at a 500,000 ticket size, it wouldn't make sense for a firm like myself, who has the skills and understanding of some degree, to get involved in a 500,000 Rand ticket size, nor would it for Standard Bank and their skilled professionals who understand energy, the energy sector, to get involved. So then it becomes around, as energy efficiency consultants, how do you expand your knowledge base around the financial instruments that are around? And they're not complex, especially if you talk about asset finance. It's not something that's complex for a lot of your clients to access. If you look at, from a property finance perspective, it's not the most complex stuff for many of the mid-tier clients to access. It's about awareness, and that's what we're hoping to get across today, is that for those types of numbers, it makes a huge difference for an energy efficiency consultant, because you're working on a volume of clients, a portfolio of clients that you're doing these transactions for, and your work is an advisory. So you're making your money out of that. You could potentially also provide some advice around the financing components. And I think that's where SAEC is coming in, is to say there's the skill gap. And at the moment where I see that that burden of responsibility as such is going to fall on EE consultants in getting some exposure and understanding to the financial instruments that are available. And you don't need to have access to a Darosh to get a 500,000 Rand application pushed through. You just need to tell your client, just put it through as a standard asset finance transaction with your banker, whoever that banker is, and it shouldn't be a problem. Coming to the case studies, then it becomes, well, all of those applications sort of, go into the black hole of asset finance, and you don't really know what's energy efficient projects. So that's my little piece, and I think I'll hand over to Benjamin to give him his insights.
Thank you for highlighting that important point, Nadia.
Thank you, Nadia. No, the only thing I wanted to add is the question was, are there example kind of case studies of banks lending? And the other question was, is there any examples of private equity funding? And the answer, particularly to the latter, is almost certainly no. We've had engagements with Metier. Metier's raised a couple of kind of resource efficiency funds, particularly looking at energy and energy efficiency. They found it extraordinarily difficult to fund into the energy efficiency piece of that. And so, you know, almost 90% of the fund, if not more, went into renewable energy. I think there was another fund as well that was funded by KfW, if I'm not mistaken, again, using kind of private equity type instruments. And again, you know, where they did fund energy efficiency, it's in kind of proper chunky projects, which, you know, where energy efficiency was a subset, if you like, of a wider set of interventions, and covered things like, you know, combined heat and power engines and things like that, right? So you know, where there are bigger ticket sizes, and often there are cash flows associated to it, you know, that's where kind of private equity and project finance typically plays.
Thanks, guys. Thanks for your contributions over there. Much appreciated. Dirosh, there was a lot of questions that came in on the chat. Is it okay if I maybe just bring it over here to this forum? I know you answered it there.
You may, Keith, no problem.
Sure, thanks. So one came from Chris Mbori, lovely educator in energy efficiency. And a question was to you on, can energy generators incorporate energy efficiency projects in their projects with off-takers?
So Keith, yeah, and I think this leads nicely from Ben's last comments, but you know, in line with my response, we often see that that's exactly what happens. You know, you remember in my presentation I said that, you know, when you're dealing with a credible solution provider, it's almost a sin not to look at the energy efficiency component, right? To just jump to the sexy solar PV plant. And, you know, that's what we've observed, that energy efficiency, like I said, is the first pit stop. What we find is that when these projects are presented to us in a wrap solution, it normally would comprise probably, you know, for simple operations, 20% of the wrap project, right, at most. And that's something for us to very easily get our minds around and provide one sort of funding solution into. Where you have, you know, your heavy industrial type of operations, you generally find that energy efficiency can become substantial, and the dynamics around that need to be understood a bit more carefully. So we might separate the two, but they can be presented to us as a, you know, as one solution, and we'd get our minds around it. But that's normally how we would approach that that sort of scenario. I hope that answers the question.
Thanks. Is there anyone that wants to add to that? I suppose it was directed to Dirosh.
Sure, I'll add just a snippet on that. What we're seeing is that where it comes to the energy efficiency conversation, where, you know, in order for those feasibilities, the financial feasibilities to be presented, the technical feasibility is required. And for the baselining to take place, there's a substantial cost, particularly for mid-tier type industrial businesses. They don't quite understand the cost of the MNV requirements and the baselining, you know, requirements around that. So then if you're not able to show what your baseline consumption and demand is, how do you show where the saving is on the financial feasibility component? So again, it comes down to a burden on energy efficiency consultants to start to understand how do they sell that component to their clients and package it for the clients to understand their return on investment from the services offered.
And just taking that further, in terms of this collaboration, I think Benjamin was talking about a lot of, you know, the World Bank project. And I just wanted to, well, not kind of linked, but on your World Bank project, you know, when we're talking about ESCOs and banks, have you guys been in contact with, you know, these ESCOs and any banks in terms of, you know, developing this stuff? Yeah.
Yeah, I mean, and I suppose kind of it's worth noting that, you know, this isn't the first time anybody else has done this kind of work. You know, everybody is still looking for the silver bullet, and B, and therefore kind of it's not the first time we've had engagements with the banks over kind of ways of trying to kind of accelerate energy efficiency uptake. So, you know, we actually did a project kind of at the back end of last year, you know, trying to think about, okay, well, how do we accelerate particularly the use of retail finance in energy efficiency? And we've had some early engagements with a number of the banks. And I think what's quite nice, and this links back to the conversation around ESG, is that there is increasing appetites to try and understand how underlying portfolios are of debt within banks are performing, and to see, okay, well, what kind of metrics can we start to try and pull from that? I'll give you an example. You know, this is in the UK. You know, we did some work with Barclays Bank, who were desperate to try and understand, okay, well, you know, how green was their residential mortgage portfolio? And so, you know, actually there is increasing appetite, I think, to try and understand, you know, how can we green traditional investment classes, you know, and I think kind of, you know, that will increasingly come into retail finance. So I think in future, we will start to see a preference for, you know, green asset classes. And if we can start to introduce things like, you know, approved technology lists and accredited suppliers and all the rest of it, I think that's really going to help banks say, okay, well, you know what, you know, I'm much more interested in you kind of using your balance sheet to fund these kind of things, and actually that helps me hit my metrics as well. So I think, you know, that the conversation is getting easier. I think is kind of what I'm reporting.
Thanks. George Leonard offered some food for thought. How is the manufacturers of these energy efficiency projects being evaluated against their own carbon footprint in manufacturing these products? If not, are we not creating a bigger environmental problem trying to be energy efficient? Any thoughts on that?
Yeah, I'll jump into that one very quickly.
Okay, all right.
And then Durosh. It's a lovely idea. I love it. I think it's a great question. I think in the South African context, I cannot overestimate how nasty our electricity is. Right? It is shockingly bad, right? And if you lived in my house and you were a victim, you know, and my children would report, I don't tell them to switch the lights off because it costs money. I tell them to switch the lights off because of the horrible kind of, you know, environmental impact that South African electricity has. So in a South African context, it's a no-brainer. But, you know, actually the really interesting point around kind of energy efficiency in a wider African context is that Africa, you know, as soon as you kind of go north of Zimbabwe and even then, most of the electricity is hydropowered. So actually energy efficiency has very little kind of carbon offset. So it's a really good question. I think nevertheless, it's, you know, energy efficiency is important just from a general resource efficiency perspective. And the fact that kind of energy security is increasingly a concern in a lot of sub-Saharan Africa, which is dealt with through diesel gen sets today, and that's extremely nasty. So I think energy efficiency, on the whole, for the most part, is you know, a carbon positive point. And indeed, actually, if you look at the models that are developed by the IEA and so on and so forth, if we are to hit decarbonization in, you know, targets of, you know, by 2050 of the Paris Agreement, energy efficiency is a massive kind of lever that must be pulled. How are these manufacturers kind of you know, impacted? Well, they're impacted by the same as every other kind of, you know, private sector operator. Regulation, carbon taxes, increasingly difficult access to finance if they aren't shown to be kind of moving with the times. You know, stakeholder expectation, customer expectation, you know, all the traditional pressures that we're seeing kind of in the private sector. Dirosh.
I think you covered it well, Ben. And with regard to, you know, the reality is they're part of the same global economy and ecosystem, and basically whatever. And that's why, you know, I made a comment saying that, you know, full value chain analysis is definitely something as a bank that when we're assessing a project, to understand how, well, you've seen the mail publications that were put out in terms of how careful we are around funding, you know, projects that don't have the correct green, you know, criteria. So I think pressure is on everyone. And if you're a manufacturer in the sector, you need to take responsibility for how you approach it. I think, there can be more, a better focus, and I think that will come with time. But for now, we're seeing the telltales of a shift in the right direction, even in South Africa. Yes, Nadia.
Thanks, Darosh. What we are seeing as well is that, there are responsibilities that are getting put onto producers generally. So there's a piece of legislation around producer responsibility. And that comes in from a recycling perspective, understanding the energy usage, etc. So that is coming into effect. It was supposed to be affected earlier this year. With COVID, everyone's getting some leniency out of government, but it will be coming into effect. So I think that that's really good. It's not going to only be the responsibility of local production and manufacturers, but it's going to have a see-through from an import perspective as well, because it's all well and good that we talk about green and energy efficiency and renewable energy and all of these things, but then we go and we dump packaging into the landfills. So there is a view of saying, there is an end-to-end responsibility that's coming into play, and manufacturers generally really need to start understanding that it's going to be a requirement. It's going to be a compliance requirement with hefty penalties and fines attached to non-compliance.
Thank you guys. I've also seen a lot of guys come in there and they want to reach out to Dirosh and to you guys. I hope that's okay with you guys. Dirosh, especially with the financing solutions, and Nadia, especially with the options that you guys have provided. And thank you guys. I hope it's okay. And I'm always approached with this, Dirosh, where after these sessions, the guys come to me and like, it's nice that Standard Bank is doing this, but every time I go to the bank, the banker that I see there, when I start talking about this, they kind of look at me confused, So, I just want to come in and just, kind of get your thoughts on that. What's your challenges on the real application, out there?
So Keith, sorry, that was directed at me, right?
Yeah. Yep.
Okay.
Sorry about that.
Being a little bit too eager, maybe. So I was just reading the comments. I think Nadia covered it very well in her, and that's why I was very grateful to her when we were planning for this. And so she's doing the heavy lifting and the technical stuff around the funding. I was very pleased to see I'm going to get time to talk about our innovation and what we're doing as a bank. But I think she covered it well. The challenge is in a borrower actually articulating the story effectively and well enough. And generally what you find is that, the groundwork hasn't been done for them to understand their value proposition well enough in the first place and how it competes in the market. And, we offer a lot of guidance, in that respect. But generally what you'll find is that liaising with someone like a Nadia would take you a long way in just holding your hand, getting you to a point. And then, when it's presented to the bank, it's very important to put your best foot forward first. It's a lot easier to get appetite up front and then move it to an approval, as opposed to saying, no, these are the reasons why we're saying no, and then you got to go back and arbitrate. So that I think is the biggest challenge for us. And yeah, so hopefully that answers the question.
Thanks, Dirosh. It definitely is a challenge, but I'm so glad to see the innovation going on in the space with Power Pulse. Congratulations once again. I want to try and wrap it up with the 2 minutes that we kind of have left. I hope all of the questions were kind of addressed, guys. I'm not going to go through each of you guys for final points. I'm going to try and wrap it up. Nadia, as Dirosh has mentioned, we thank you for doing all the heavy lifting. We needed someone with some real strength over here, to do it. And I think, thanks again. I love the way you painted such a great picture to guide people around that first step in terms of, where to go. Thank you for highlighting the point about education, and thank you for supporting the SAEC. As an association, that is the idea over here, is to kind of trying to get the ball moving, try to, through education and make that link. So thank you for supporting us in that area there. Dirosh, thank you for showing us the innovation that Standard Bank is doing in this context. I do recognize, with your MVP approach, going to a select few, it's good that progress is being made. And please, keep us up to date, because there's so many companies that's from the SAEC that can use that knowledge to take it further to their clients and to businesses and try to promote these projects from going ahead. That is such a great thing, and definitely the challenges are there. Benjamin, it's so sobering to listen when you speak sometimes. I've got to write so much, but thank you. Just to try to keep up. Lots of questions that I hope the guys can reach out to you in other stages. It's so great to see the work that you're doing with the World Bank and South Africa. I love the lens that you use. You not those glasses lenses, but the opportunity that's available, and how you kind of just say, but why aren't we doing it? Why can't we just move forward? And it's so great to have you as an ambassador to the country. Thank you for your knowledge, and thank you for sharing it with the SAEC. It is definitely something that we can take the conversation forward. Tell Barry Breedenkamp, thank you so much for allowing us your time. It's really through Barry that you came, and we're so grateful for that. Thank you all to our members, to our guests that have joined us. We really hope that you found this session valuable. I see the comments in over there, and like Nadia was saying, it's the education is the first step in the link that we can actually start to promote. Once understanding is out there, then it's really people using these tools that can go out and really make a difference. So I just want to say thank you all. Thank you for the great questions. I'm 2 minutes over, so apologies for that. But thanks again, guys, and have a great afternoon and evening.
Guys, ladies, just before you leave, can I quickly ask you to switch on your videos for us? I would really like to see the faces that's attending our webinars.
If you're having a bad hair day, it's okay. We're not going to share this on social media.
Okay, that's all from my side. Keith, thank you.
Okay, so there was sort of like attendance register in the new age of digitization. So thank you so much. And thanks again, guys. Please have a great afternoon. Speakers, thank you so much.
Thank you all.
Fabulous.
Thank you, Keith. Thank you, everyone.
Thank you. Bye-bye.
Bye.
Bye.